Welcome to Corporate Finance. I'm Natasha Texton, and today we're going to be discussing annual financial statements. The question we're going to be answering is, what can financial statements really tell you? When some people pick up a set of financial statements, it looks like mumbo jumbo. It looks like a grappled amount of information that's jumbled upside down, and you can't really extract what's vital from that information. Hopefully after this session, you'll be able to pick up a set of financial statements and actually extract some good information that will help management decision making as well as investment decision making when looking at those financial statements. So what can financial statements really tell you? Our outcomes in this session are to understand how to interpret financial statements using ratio analysis and then be able to analyze and make management decisions based on the financial statements. Obviously, we're not going to be able to analyze financial statements in this video lecture, but through the case study that follows, both of these outcomes will definitely be achieved. So, what is a set of financial statements? I know it seems boring to start with a definition, but it really provides us with a balance board or a leaping board from where we can start. Financial statements are a written report which quantitatively describe the health of a company, the financial health. So is there money? How much are the loans? Is there actually income? Are we actually earning something? And these financial statements generally include three things: a balance sheet, an income statement, and a cash flow statement. If you look at the annual report of a listed company, you'll actually find that there's a lot more information in there, but we don't have enough time to cover the whole annual report, so we're going to focus on those three statements. Let's just take a step back and look at a simple example to just explain this concept. Let's think of something like a little girl wanting to sell lemonade. I think it's something we can all relate to. What do we need for this little girl to really achieve her goal of selling lemonade? Well, number one, we need the budding entrepreneur. This little girl needs to be really excited, and I'm sure by the end of the day, maybe not so excited when mom needs to step in. But for now, we're going with she's excited, she wants to do it, and she really needs the resources to do it. What resources does she need? She needs a stand, she needs some lemons, some water. I think sugar goes into lemonade, and preferably some money because she's got to go and buy these things. Now, where is she going to get the money? Well, number one, maybe she's got some pocket money saved up. But if she's like most children, probably not. So where are we going to go? The obvious choice, to dad. Because dad, of course, has an endless supply of resources that we can use. In this example, what's going to happen? Dad's going to lend her money. She's going to go and buy the resources she needs to sell the lemonade. And on a really hot day, we hope there's going to be a queue of thirsty children who actually want to buy her lemonade. Once she's sold them the lemonade, and she's actually made what she's trying to do, at the end of the day, she probably needs to pay dad back. Although, wait a minute. Do you really think dad's going to want the money back? In this example, maybe not. But practically, if we borrow money from the bank's going to want the money back. And that money will come from what we've made. If we look at this example, we need to go to the concept of the accounting equation. This is the principle of every debit's got a credit. They always say do things balance, and this equation helps us actually achieve that goal. Let's look at do things balance. Firstly, we have the little girl and her pocket money that she put in. That's what we call owner's equity. So what did the owner put into the business? That's the first thing. The next thing we're going to look at is assets. What are assets? Assets are those things we have that we use to generate income. So what could assets be? Well, in our lemonade example, it could be the lemonade stand. Without the lemonade stand, she'd have nowhere to sell the lemonade from. What else would she need? Well, she'd need lemons and water and sugar and money. Although it's strange to think of that as an asset, we need those things to actually make the money. So assets can be split into long-term assets and short-term assets. So longer-term assets, something that I'm going to use over an extended period of time, like the stand. Or short-term assets, well, hopefully she's only going to have the lemonade, which would be inventory, for a really short period of time and she can sell it. But both are assets. And lastly, we have liabilities. Who do we owe money to? Well, in our example, we owe money to dad. And we've actually got to settle that amount. Liabilities, again, are also short or long-term. So like the creditors, we have to pay short-term, or a bank loan that we pay over an extended period of time would be long-term. So the accounting equation, to check everything is always in balance, is owner's equity is equal to the assets less the liabilities. So at any point in time, the value that the owner has in that business, so what the little girl has, will be the sum of all her assets, including the money that came in from the sales, less all the liabilities, the amount she needs to pay to dad. Let's put that in a financial statement concept. If I were to look for the accounting equation itself, all of that information is lying on the balance sheet. It shows the owner's equity, the assets, and the liabilities. If I were then to look for the information of the cash flows of what came in and what came out, that would be lying on the cash flow statement, literally like it says. That information says that if I'm looking for the cash flows, how much money did she receive from sales, how much did she pay for the water, how much did she pay for the lemonade, it's all sitting on the cash flow statement. Lastly, if I want to look at the income, so what's the income less the expenses, that's going to be sitting on the income statement. Why do I need an income statement and a cash flow statement? In this example, not so relevant, but practically you have creditors and debtors where the flow of the actual sale is not the same as the time frame in which you're actually paying for things. So if you buy something and you only pay at the end of the month, there's going to be a difference between what's lying on the income statement and what's lying on the cash flow statement. So let's look at each of those elements together. The balance sheet shows owner's equity, assets, and liabilities. The income statement shows the sales, the revenue, the cost of those sales, which will get me to the gross profit, and all the other expenses, including taxes, before I get to net profit. And the cash flow statement is the cash inflows less the cash outflows, which will give me the net cash. So now we know what's in the set of financial statements. But do I really know what they're telling me? Well, maybe a bit, but this is where ratio analysis really adds some value. So we can look at a set of ratios where we compare things within the financial statements, as well as with other industries, as well as other companies in our industries, and over time. So how did we do last year versus how we're doing this year? When we look at this ratio analysis, we're by no means going to have all the ratios that can possibly be done on a set of financial statements. I've merely extracted a few key ratios that we can actually address. So the first type of ratio is a liquidity ratio. What is a liquidity ratio? Well, a liquidity ratio is a ratio that says how liquid is my cash? How quickly can I turn my assets into cash and pay my liabilities? The first thing I'm going to say is, what was the net cash flow on the cash flow statement? That's step one. Did I get more money in than I paid out? How much is lying in the bank overdrafts? Because if there's a lot lying there, if it's not explained, maybe there's a risk that will come out. The ratio we do there is the current ratio, where we compare our current assets to our current liabilities. How quickly can we take our current assets and pay for those current liabilities? Is it possible? Or is there actually a gap? Don't we have enough cash to pay those current liabilities? The second ratio is profitability ratio. How profitable is this company? How much of the revenue that I'm making is becoming profits that can go to the shareholder? And in this element, we've got two ratios we can look at. The first is gross profit ratio, where I take the gross profit, which was my sales less my cost of sales, compared to the sales number. Or the net profit ratio, where I look at the bottom line. What was the net profit I made divided by the sales? Again, we can compare this ratio to how we did last year or other companies in the industry, so we can see how we're performing. Are we profitable? Are we actually competitive? And is this an investment you want to make, or is there a management decision that needs to change? The next question we need to ask is gearing. How much of this business is funded by owner's equity? So how much did we put in by shares or whatever? And how much is financed by loans, long-term loans? How much have we got from the bank? And this sort of ratio we can compare with other companies in our industry. There's a whole discussion and assumptions and principles around capital structure and is there an optimal split between debt and equity? That will be covered in another module in the corporate finance session. For now, we just want to compare what ours is to other companies and make decisions. The last thing we need to consider is, if I'm an investor, how much return am I getting on the amounts I've put in? For every £1 or £1 or $1 that I put in, how much am I getting back? And that's going to be the net profit divided by the total assets. So are we really getting that benefit? Or is it going to be better for me to take my money and put it in the bank and earn interest? That's what this ratio is going to answer. So using these ratios and a set of financial statements, The financial statements can actually tell me a lot. By comparing them over time and comparing them with other companies, I can make informed decisions. And this principle will really come out through the case study that's going to be attached to this lecture. So in closing, when I look at a set of financial statements, I'm going to see a balance sheet, an income statement, and a cash flow statement. And if I use them effectively with ratios as a tool to analyze what they're telling me, I can actually make an informed decision from a management point of view as to how to cut costs or increase sales, and from an investor point of view to keep my investment with one company or move to another. I hope you have enjoyed this lecture and that you'll have a good day. Goodbye.